Financial services have always been prone to technological disruption, a condition exacerbated by regulatory changes imposed after the 2008 crisis. Those changes, along with new technologies and the power of big data, have created new opportunities for non-banks to compete with banks on their home turf, lending. Additionally, new business models and distribution channels and a deeper understanding of customers have given new types of lenders an opportunity to break into the business in new ways, particularly in so-called peer-to-peer lending.
Probably the most important dimension is the interface that the customer has. It is usually not a person-to-person interface. It is through either a mobile device, a tablet, or sometimes a PC or a Mac. The second part is the overwhelming amount of the analysis and processing is done through algorithms and technology. So it vastly reduces the amount of human intervention. That makes it much more objective. It expedites it dramatically, and it significantly reduces the processing cost.
In terms of how we price risk, we use all machine learning models with thousands of attributes that we analyze, as opposed to the traditional methods. What that does is yields a better process in which we can differentiate risk. And then based on that, we can actually see if the loans are performing to how they're expected to perform.
What peer-to-peer platforms offer is a better experience and service model, as well as lower rate. And the way they're able to do that is by using technology to acquire customers and underwrite loans. And what you're increasingly seeing are bank partnerships. Banks are able to bring a low cost of capital, platforms have low OpEx, and there's a natural marriage between both of those together. What we're seeing in marketplace lending is the rise of institutional investment. It's quite interesting because a couple of years ago, major ratings agencies were reluctant to offer ratings, and of course now you're seeing the growth of securitized products and a stair-step increase in securitization activity. What institutional investment brings with it, though, is a set of challenges. There needs to be standardization to help institutions price, describe, and exchange the risk.
Regulation has multiple dimensions. The first is what are the legal requirements that you must meet. The second you have the regulatory pressure that is brought by government to enforce its will in moral suasion.
The only area that I believe we're less regulated than the banks, which we compete and are disintermediating, is that we don't hold deposits. And so if we lose capital, it's going to be investor capital. And at the end of the day, I think the key is to make sure that we provide great products to consumers, and we're subject to all of the regulation at the federal and state level today.
There'll be a rapid growth in institutional capital flowing into the category. It's really necessary to fund the dramatic growth in origination volumes. And with that comes a need for institutional grade credit risk analytics to support a growing securitization ABS market. So we think there'll be a thriving, robust securitization market that underpins the growth in marketplace lending loans.